Have you ever had a moment when you just have no chance left? No? Well, it doesn't sound great, but after this video, that's exactly what will happen. You won't have a chance to take a wrong turn in learning scalping. In this video, we'll break down strategies, discuss exactly what you should be focusing on and what you shouldn't. So everything that's said in this video is material that will be useful to you and will help you understand where to go and what to pay attention to. And all the unnecessary stuff will be filtered out. So let's get started breaking down strategies and scalping. First, let's figure out what exactly is this scalping of yours, right? Why is everyone talking about it? What kind of phenomenon is it in trading? And after browsing YouTube a bit, I see statements like scalping strategy. Scalping is a strategy. I trade using scalping. And that's pretty strange. Why? Because right now, we're going to settle the definition of scalping once and for all, but in simple terms. Scalping is not a strategy. Scalping is a type of trading that involves trading on small time frames, or in simple terms, capturing short price movements. This is done by looking for entry points on small time frames such as 5 minutes, 1 minute, 15 minutes, and no more. On these time frames, we capture short movements. And yes, we might stay in a trade for 5 seconds, or we might stay in a trade for 5 hours, and it would still be considered scalping. Why? Because we found an entry point on a small time frame, took part of the move, say locked in some of the position, meaning we took a small profit and let the rest run. No one is limiting us by time. The point is that we looked for an entry on small time frames from local levels, and that's why it's called scalping, yes. But we can also scalp very quickly. Enter, catch some impulse, and exit. So let's summarize a bit. Scalping is trading on small time frames and capturing short moves. In the simplest terms, without any complicated words. Now, where do we capture these short moves and take small impulses, and where can we hold on longer? And now we're going to break all of this down in the strategies that we most often use in scalping. This is what you need to study. This is what you'll be trading. You'll either pick one or combine them and trade them all the time. Believe me, this will save you thousands of hours. And this video will help you move in the right direction. Let's get started. And yes, I almost forgot. I wanted to mention where beginners most often make mistakes. First, they trade without a strategy, which we're about to go over. Second, they stay too long in losing trades. In scalping, that's unacceptable. Decisions must be made instantly. This is the third point. In other words, quick decision making. And let's jump back to the second point. You can't just sit and wait. You can only hold on in profitable trades and let the profit run. We cut losing trades at the root. That's it. These are the 3 key factors that will always help us in scalping. First, you need to learn horizontal levels. All the main trading still revolves around them. Breakouts, bounces, and everything else we're about to discuss. All of it comes from the levels. That's why it's absolutely necessary to understand horizontal levels. Second, you need to see the volumes, to see where the money is being poured in, because these points are more often defended, right? Volumes are defended. When volumes come in and the price returns to them, they are defended and there is a reaction. In other words, you need to be able to see and understand the chart. And third, the speed of decision making, as I already mentioned. Scalping is not for indecisive people. You can't just sit there and hesitate. You should only hesitate when you're deciding whether or not to enter a situation. We've found a horizontal level and decided to work it. That's it, we're ready to press the buttons and nothing will throw us off. Only this way can you actually do something in scalping. That's all. Now let's really move on to the strategies. And the first strategy is a classic one. You've probably heard about it in many places. And it really works and brings profit. But first, a little background and theory about this strategy. A breakout strategy is about finding a level that has already seen a lot of trading, behind which a large number of stop orders have accumulated. These are the stops that will fuel our growth. Now I'm going to show, illustrate, and break down a trade example. A breakout in scalping is about catching a strong impulse and immediately closing the position to take the profit. In other words, a quick, strong impulse. But in this case, this strategy also allows us to stay in the trade for a while. So you catch the breakout, close part of the position, or simply move your stop loss to break even after the impulse goes in your favor, and then wait to see if the price continues to move further. That's it. And here, it's up to each trader to decide how to trade. I take short moves, I take impulses, and I rarely stay in a trade for long. You can learn to hold your positions longer. There's nothing wrong with that. What do you need to learn to do for this strategy? First, of course, you need to be able to identify levels and understand what a level actually is. Second, you need to look for the right entry point. Third, you need to understand the rationale for entering a trade. In other words, what factors indicate to us that a breakout is about to happen. And fourth, of course, is understanding where to place your stop loss. And actually, this fourth point should really be the first. You need to know from the start where your stop will be. If the stop is not somewhere far away or is unreasonable, then we don't take that trade. Let's switch to the small screen and break it down. Friends, colleagues, I can't help but recommend to you the exchange that I personally use, which has proven itself as a top exchange and has been on the market for a very long time. This exchange is also open on my screen right now because I'm buying coins on spot. Yes, I'm doing this specifically on the BitGet exchange and picking up coins that haven't multiplied yet. There is a very large selection of coins here, and it's even bigger than on other exchanges, which is a plus. There are also constant listings here, with new coins regularly appearing that perform very well. And for beginners, there's always an opportunity to take part in various events that help you earn pretty good money from a small amount, thereby increasing your deposit. Yes, your capital. For example, things like launchpads and launch pools. There was a recent launchpad where we made a couple of X's, which was very nice, so be sure to register. The exchange is reliable, I use it myself, and for our partners who register using the link, we even hold special giveaways together with BitGet. We've already had a merch giveaway and there will be another one soon. Grab all the links and bonuses in the description. So theory, let me illustrate for you graphically how this should look. So we have a level, we have some kind of level, right? Let me start by drawing how it forms, okay? We have some kind of price movement, and we understand that here we have a horizontal level. We understand that it's a horizontal level. And here's a subtle point. A level is not always a precise line. A level is generally a price range where a certain player steps in, meaning either a buyer or a seller. And that's something we need to understand. Candlesticks aren't drawn by someone. Candlesticks are actually what happens on the chart. So green candles mean buyers are dominating, red candles mean sellers are dominating. And that's important to understand, right? And we don't have any strict lines, with a small exception. A strict limit level occurs when there is a large limit order in the order book that prevents the price from moving up or down. In that case, there will be a strict line at that liquidity cluster. When there is no such liquidity and the chart simply draws us a level, yes, we have a graphical level, then it's still just a certain price range. That's why we often trade cascades. So, a cascade is a cluster of highs or lows at certain values, as I've drawn here. You see, here the price doesn't hit a single line exactly. Here, the price forms a small cascade or a narrow price range, which also serves as a level. So, when a level has been traded, our task is to find an entry point and catch the impulse during the breakout. What causes this impulse? This impulse happens due to the activity of a large player or because of a cluster of stop losses. Whose stop losses? Those who are trading a different strategy. What other strategy? Where there isn't a breakout but rather a rebound or a bounce. We'll get back to that in a moment, or rather move on to it. People who enter on a bounce here place their stop losses right here, beyond the level, beyond their entry point. And when the price reaches their stop losses, if someone opened a short, their stop loss is a buy order. And along with the major player who is buying at these levels, the price also reaches the stop losses which get triggered and buying starts to happen. That's when a strong impulse occurs. We need to understand the points where these stop losses have accumulated, and stop losses tend to accumulate beyond obvious levels, so we capture that impulse. That's how the breakout strategy works. Let's look at a trade where I caught a breakout. For example, I have a breakout on XRP. It's not a new trade, but I found it in a folder, yes. Right now, I don't have much time to trade because of trips, work, filming, and so on. But still, there are some trades, and we can see a clear cascade. You see it, right? Here it is, the level. So here, two highs almost hit the same point, and here it falls a bit short, and here as well. I mark the cascade and enter on the breakout of this cascade. I set my stop loss right here, behind the consolidation. And the movement starts to develop, the first impulse comes, and my goal is to take at least 1% from here. It keeps going, the movement develops, breaks through this cascade, and we get this kind of impulse. And in the end, I take my cherished $100 from this quick situation. You can see with 2 candles how the breakout happened. Not bad, really not bad at all. So that's how breakouts work. This is the first strategy you need to pay attention to. Let's move on to the second one. And the second strategy follows from the first. All our strategies flow from one another. The second strategy is a rebound or bounce off a level. What's the logic and how did it work for me? When I started, like everyone else in scalping, by initially trading breakouts, I realized it wasn't working for me. I kept getting stop loss after stop loss after stop loss. I understood a simple logic, which probably everyone has at some point. What if, instead of trying to enter on the breakout, I trade the opposite way, against myself? That is, where a breakout of the level up or down doesn't happen, there's a bounce. In other words, the price, the coin, doesn't have the strength to break through that level. And at that time, I still didn't understand how to trade breakouts correctly. Now, even on streams, I've gathered 3 months of statistics, yes, where I showed positive results in breakouts. But that's now with experience. Back then I didn't understand it. So I started trading, trying out bounces, and I began to succeed. I started to feel the profits because I simply stopped fighting with myself. If I don't understand breakouts, then wherever I get stopped out, that's where I should enter in the direction of the stop. And I started taking bounces off the levels. I started to succeed. And now let's move on and see how these bounces work. When our level is weakly traded, when a price movement forms a level but nothing really trades there, and the price approaches the level impulsively, often there is either a small false breakout or an immediate bounce off the level in our direction. When a level is weakly traded, when it only has 1, 2, or 3 touches, and there's no real consolidation below the level, the kind that interests us for a breakout, the kind we can place our stop loss behind. If none of that is present, I just started entering on bounces. They started to work out, as I already mentioned. So we look for a weak level that has just formed, and we take a bounce from it. We place our stop loss behind it or behind a round number. A round number, in other words, is one of the factors of a strong level. And in this way, we capture the bounces. So this is the second strategy. Where there is no breakout, there is a bounce. This is what I recommend beginners start with. This is what will help you get some practice at the beginning of your journey. What's good about the bounce strategy? The fact that bounces happen much more often than breakouts. The fact that we can take short moves or we can take long ones. By the way, I'll now explain where we can hold on and where it's better to take the move that just happened right away and not wait for further development. You develop an eye for the charts, you gain a tremendous amount of experience by trading bounces because they happen more often. And since I mentioned where you can hold and where you can't in these strategies, let's take the example of bounces, right? And we hold our position if the bounce is going in the direction of the trend. And it's better to trade everything with the trend. The same goes for breakouts. If we've had a trending move like this, right? And then the price starts consolidating, building up some level. So we have an upward trending move and the price is consolidating and then we get a breakout. This is where you can hold your position. But if we're trading the lower boundary, the lower level against the trend, right? Here, it's better to take a small impulse and exit right away because the price is very likely to move in the direction we want. With the trend, you can hold your position. We close part of the position and hold, but if trading against the trend, we just take the reaction. That's it. It's all simple. And the next one is also one of the easiest. So in essence, breakouts are the most difficult. You have to wait a long time for them. They're hard to work with because they don't always happen, but they offer a good profit in terms of risk to reward potential. And the next and final trade for us is of course trading from liquidity levels. Basically, this is the essence of scalping. Some call it pip trading, order book trading, whatever you like. But liquidity levels are exactly what this is about. How do you find them, these liquidity levels? We used to look for them manually, but now there are screeners. I often get criticized for supposedly advertising something. In this video, I will deliberately not mention which screener I use, although everyone already knows, right? Now it's simple. You just pick any screener that shows liquidity levels, one that has a liquidity map or just displays liquidity, and you can choose absolutely any screener you like. You find the liquidity levels. What is this anyway? Let's switch back to the small screen. Theory. A liquidity level is a large limit order placed in the order book that prevents the price from moving past it. So we have an order book and there are different values here, right? Different values. And let's say, for example, they're $1, 2, 3, 1, 2, and here there's an order for 150, for instance. I've really shortened the numbers here to make it as simple and clear as possible. But we can see that compared to these, this is a very large order, right? 150 coins compared to 1, 2, or 3. And this order affects the price. How exactly? When the price approaches it, it bounces off because the market can't handle such a large quantity of coins. And there's a bounce because at this level of density, in this case, sell orders come into play and the price moves down. So we find a dense area and enter on the bounce if it hasn't been traded through. If the price has approached it many times and it's starting to get eaten away, then of course we no longer trade the bounce from it. You can also trade the breakdown of dense areas, but that's a topic for another time. It's better to trade bounces from dense areas since this video is for beginners. I'm explaining this for beginners. And let me show you a situation where I entered from a dense area. We see the MKR coin, and we see a dense area below it. The order book is thin. It might seem to you that I'm entering quite far from the dense area, but here on the chart, you can also see this density. So here it is, right? And here is where the price is. So I'm entering almost from it. I just loosen the order book a bit to make it easier to enter and the price starts to move. And notice there was another interesting moment here when this dense area was moved. Look at where it is now and watch where it gets moved to. They moved it, and by doing so, pushed the order book even further. So the density affects the market, the density is moved, and as a result, the price keeps going. And look right here. There. You see that, right? There. The density was moved and immediately there was an impulse. So with this density, they pushed the market up even more in my direction. So this is how a basic elementary trading strategy works. You take a screener, find the density, set it up correctly so that this density is large at a round number and stays there for a long time. Enter on the bounce and you'll be happy. Easy money. The easiest thing there is. And you can get the most detailed breakdown of all scalping and trading strategies in the educational materials at the links in the description. Good luck and success in your studies. These 3 strategies will simply give you an understanding of what to do. That's it. Go and trade, seriously. Pick one and learn to work it out. But I told you which ones are better to start with, which ones are more useful. But if bounces are more useful, that doesn't mean they're more profitable, right? There are people who trade breakouts excellently and make great money from it. There are plenty of them on YouTube as well, you can watch them. But I still recommend getting practice with bounces off levels or off liquidity walls. Bounces off liquidity walls are more reliable. Why? Because trading off liquidity walls gives us a very tight stop loss. Our stop loss is always set behind the liquidity wall, so we have a small risk with a large profit. And I want to mention one important point. When you choose a trading strategy, psychology is very important. The main psychological aspect is, of course, sticking to that very strategy. So when we've chosen, we trade bounces. You don't need to try trading breakouts or anything else like trend lines or some other nonsense. Don't do that. Just trade bounces. That's it. Your task, you should have this program in your head. I'm going to work, I'm going to trade bounces. Sit down, look for bounces and trade them. Then you'll be able to adjust your trading strategy. Then you'll be able to work on your mistakes. But when you trade everything in a row, you don't know what to fix. You don't know which entry points to adjust, where to set stop losses, where you put a stop loss correctly and where you didn't. Why? Because you're trading everything, but when you trade just one thing, you have a clear understanding. When trading bounces, you can see, okay, I made a mistake here. Here the stop should be a bit longer. Here I entered too early. You shouldn't enter a level ahead of time. And we adjust, and adjust. That's how it is, guys. So use this to your advantage, trade, keep learning, and don't forget to subscribe to my free Telegram channel. Definitely. I'll be waiting for you there. There you'll find the coolest scalping chat you can get in the Russian-speaking community. Join in, chat, and share your situations with the guys. I wish you profits.